Good morning everyone and welcome to this edition of Morning Markets on Tuesday the 4th of October. Now you'll see on your screen that yesterday was a strong day for all major asset classes as markets began the new quarter in strong style. We want to spend the majority of today's update focusing on the UK and in particular the ongoing U-turns by Chancellor Kwarteng with regards to UK fiscal policy. Recall the update yesterday about the abandoning of removing the top rate of tax. Now, whilst this 45p rate has only modest fiscal impact in terms of its revenue-raising abilities, it does indicate a harsh dose of economic reality is beginning to hit this new Treasury team, particularly the Chancellor. And this news has been received very well by both currency and UK bond markets, in particular with gilts rallying back to almost where they were on the day of the original mini-budget announcement back in September. Now, there's likely to be further good news for UK markets, given that the Chancellor has agreed to bring forward his next fiscal announcement from late November to late October. But even more importantly, it is going to be fully costed, and this suggests a greater balance between future spending pledges and more realism on the likely revenue-raising targets within that. And it will be the Office for Budget Responsibility which will provide that independent oversight ahead of the next Bank of England meeting in November. And that's really what's key here, is that by bringing it forward, the Chancellor will allow the Bank of England to have a look at this fiscal statement in full and provide some initial forecasts to go into their monetary policy decision in November. Now recall that markets still do expect a rather large, an unusually large interest rate hike in base rate in this forthcoming November meeting. Base rate is currently 2.25%. Markets currently think it could go as high as 3.5% in that November meeting. And that's one of the reasons why we're now seeing very large increases in mortgage rates on the UK high street. The average two-year rate has now risen above 5%, which is a rate that we haven't seen since 2008 in the midst of the financial crisis. Now, encouragingly for the UK bond market, for the government who are borrowing in the bond market, is that yields on longer dated bonds have fallen back to where they were on the day of the mini-budget. And this is largely attributable to actions taken by the Bank of England in their emergency intervention last week. Recall that they surprised markets by intervening in the gilt market in order to try and bring yields down, that is, raise the price of bonds to provide stability to defined benefit pension funds. And this has worked remarkably well. The bank had indicated that they were willing to spend around £65 billion over the next 2 weeks to support markets. So far, they are unlikely to spend anywhere near that. To give you an idea of this, yesterday they looked at bids for around £2 billion worth of bonds from the market. They accepted only around 22 million. So there was actually no need for them to intervene, but by just giving that signal that they are willing to intervene, markets have taken that support very, very well. Now, in the US, we had some data yesterday that indicates that the global slowing in the manufacturing cycle is now feeding into the domestic manufacturing cycle in the United States. We are seeing broad-based weakness across new orders and within the employment subcomponents of the US services and manufacturing indices. Now, what we expect here is that the US will likely lag the global slowdown in manufacturing. Manufacturing is not a dominant part of the US economy. It accounts for only about 15%. But it's likely an early indication that the US will not be immune from this slowing in manufacturing, which is mainly dominant in Europe and in China. And that's one of the reasons why bond yields in the US also fell yesterday. It may also explain at the margins why US equities outperformed yesterday, in that markets were taking the read from the bond market that rates may not go as high as was originally feared, say, 2 weeks ago, and that this may elevate equity prices somewhat. Now, as we go through the rest of the week, we get more data from the US, particularly jobs data on Friday, and that's going to be the main focus. Recall that the Federal Reserve would like to see the unemployment rate rise modestly over the next year to try and bring some cooling into the wage market. This Friday's print will be the first print we've seen since the last meeting of the Federal Reserve when they updated their forecasts. So all eyes will be on that forecast. But please join us tomorrow as we update you further on events in global markets. Thank you.
If you're interested in taking your investing to the next level, or would like to know more about the options available to you when you retire, then download our free guides to ISAs and pensions. These are available in the video description below.